Hello everyone, hope you guys are doing well today. So let's begin with our second technique of weighted average method, that is a periodic method. Okay, mainly if you see weighted average costing, you see two words, periodic and perpetual. Okay, what does periodic mean? What does perpetual mean? Perpetual means continuous. Perpetual means continuous. And periodic means once a year. Okay, so when we talk about perpetual inventory method of weighted average, you are continuously having a process of calculating the averages on each purchase or sale, basically purchases. Okay, but when we talk about periodic, we do it once a year only. At the end of the year, whatever the cost that we are having, let's say we are having a cost of 100,000, we are having a cost of 100,000, and we have bought 10,000 inventory. We are just going to divide it up, and we're going to get the average cost out of it. Nothing more than that. The periodic method is very easy. Take all the purchases, the opening inventory divided by the opening inventory plus the purchases units of the particular goods. So first of all, the numerator will be the cost, denominator will be your number of units, and that's it. So periodic is very easy. We are doing it once a year, and perpetual is a continuous method. So you have to take an average on each and every time when you are having a goods that is being purchased. Okay. Now let's move forward to impact of inventory on profitability. Now, this is important for you, not because of only costing, it is important for you in your financial accounting as well. So please be careful. Now, FIFO. FIFO is we are having FIFO is a situation where we are having an inventory, the closing inventory that is higher in nature. Now, if you are looking at FIFO, I'm just writing down a format for you. We have our sales less cost of goods sold. Okay, in cost of goods sold, we have our opening inventory plus our purchases less our closing inventory. Okay, and what do we mean by that? By that, we are saying that this separate calculation is going to be subtracted from your sales. The total of these three is going to be subtracted from the sales. Okay, now this is a basic income statement method of using your cost of goods sold. Now, when you see this situation, how do you interpret it? Now, interpretation should be that closing inventory is the main key concept, is the main area that we are going to focus here. Okay, that is the subject of focus here. Now, for FIFO, if you're looking at FIFO, FIFO is basically telling you that yeah, whatever goods that we purchased earlier on are going to be sold early. So first in, first out. That means oldest inventory is going to be sold first. And normally it is seen as a trend that we have an increasing trend of prices as time passes by. So if you have an increasing trend of prices, that means basically the last inventory that we would have bought would be the most expensive. Yes, if the last inventory would have been most expensive, then we are going to see a trend. We're going to see an area that the particular goods, the particular goods that are there in the closing inventory are at a higher cost. If closing inventory increases, does our cost of goods sold reduce? It does. Our cost of goods sold reduces. So if our cost of goods sold reduces, that means basically we are having a higher profit. Yes, we are having a higher profit. If we are having a higher profit, that means basically now we are in a position that we can easily say that FIFO is good for profitability. So here you have written lower cost of goods sold, higher profit, and closing inventory value will be higher here. Now, if you talk about LIFO, now that's the complete opposite of it. If you're talking about the complete opposite, the closing inventory is inventory that is bought the earliest. That means basically we are having the inventory that is bought the first one. So that would be the lowest price. So lowest closing inventory means a higher cost of goods sold. A higher cost of goods sold when subtracted from your profit is going if from your sales is going to result in a lower profit. So inventory price, higher cost of goods sold, lower profit, and inventory would be lower. In AVCO, it would be a moderate cost of goods sold because we are having average. So it won't be a very high fluctuating nature here. So it would be very average position where we are not going higher than the FIFO method or lower than the LIFO method. So moderate cost of goods sold, moderate profit, and between FIFO and LIFO. Then we have a similar situation in AVCO of periodic measure as well. So perpetual and periodic are both giving you the same indications. Now, FIFO results are higher profit when prices are rising. LIFO reduces the taxable income but is not allowed under IFRS. So IS2 is a standard that is going to be studied by you later on in financial accounting, where you're going to see that IS2 says that the inventory should be measured at lower of cost or NRV, that is a market price. So we should measure your inventory at market price or the cost that you have purchased it at. So if the market price is lower, then we have to measure it at that price. So LIFO doesn't apply. It is not practical and it is prohibited in financial accounting as well. So please be careful regarding that. AVCO provides a stable pricing approach. So I believe that the methods of accounting the costing of particular goods is clear to you guys. Let's move forward. Now, inventory transaction for the month. A company purchases and issues inventory as follows. There are situations where we are having inventory purchased and sold. Okay. So here we are seeing that 500 units are bought and at a price of 10, so total cost 5,000. So multiple transactions have been done and we have issued 300 units and 400 units. Total purchases are 1200, 1460 is the total cost of it. Now, total issues 700 units. Now, we have to solve it through FIFO first of all. That means our oldest inventory is sold first. Okay. Now, what I can do here is just for my sake, not for you guys. For you guys, you should just be first solving this because we have discussed it in detail how to solve a question like this. Solve this question on by yourself, and I'll solve it together with you. And I'll solve it with a shortcut, and we'll see the longer version as well that is already solved by me. Okay, let's solve it together. Now I'll use a shortcut and it is not requested or it is not basically prescribed for you. Do the longer version just for your practice. Now let's see. We have had purchases that are clear and are total in nature, so no, don't need to focus on that. Now we are having issues of 300. Now if you have issued 300 units, let's see. We have 500 units here present. Yes, out of which we have issued 300. So 300 issues. Now I'm just talking about issues here. Now for issues, we have 300 units that are issued at a price of 10. So 3,000 for that. Then we have 400 units issued. But if you look at this position, there are 500 units only. So if I subtract 300 by them, I'm only left with 200 units at the price of 10. So what do I have to do for the next issue that is on 30th Jan? I have to give 200 units out of 10. So my first is crossed out. January 1st is crossed out. That means 2000. And next 200 is to be given from the 12, the price of 12. The 300 units that are bought, 300 units that are bought at January 10th are to be used here. So 300 into, 200 into 12 here. So 200 into 12 gives me 240. So these two purchases are in total for 40. These two issues are total of 4,400 and 3,000. So 7,400 is the amount that we are going to issue. Okay. As per the closing inventory. For closing inventory, we are left with 100 of January 10th purchases. Yes. So 100 into 12. That means 1,200. And 400 into 15, that is 6,000, that is already given to you. So 400 into 15, that is 6,000. So closing inventory is 7,200. Your issues are 7,400 and the total of inventory is there. So this was a method of FIFO. I have used a shortcut method here. The longer method is done below just for you guys. So you are very easy upon the particular purchases and the sales as well. So you can see that the first issue was made here of 300 units, out on which we have issued only 200 into 10. Oh, sorry, we have issued 500 into 10, 310 units that are in the first 10 areas. So if we are looking at this area, this table is to be understood by us. We had 500 units at the 10 at the starting of this transaction. On the transaction event, what we have done is we have reduced 300 from the price of 10 that we have issued. So here we are basically just seeing the remaining values that are balances that are present. So 200 units at the price of 10, 300 at the unit at the price of 12, and 400 at the price of 15. So that's it. Then we are going to just use the last 400. 200 out of this is going to be crossed out. 200 out of this is going to be crossed out. 100 out at the rate of 12, and 400 at price of 15. So 7,200 is the price that we have calculated earlier on as well. So you can just refer to the table. The table is for your detailed explanation if you are not unable to go for the smaller area. And I recommend you guys to use the table, please, because it is a detailed method. It takes time, but the timing it takes, it is going to strengthen your concepts of FIFO, LIFO, and AVCO. I have been doing this for a very long time, so I'm having a good grip on it, but there are chances that you might go on the wrong path. Now, if we solve it for LIFO, if we solve it for LIFO, now in LIFO, let's just use another ink. If I talk about issued, we are issuing 300 units, then we are issuing 200 units, and we're issuing 200 units. Okay. Now let's see what we can do here. We might not be requiring to be issued the direct 200. Let's see. First of all, 300 units are at the price of 15. So 300 into price of 15 is giving us 4,500. The first sale has been done completed. First thing has been completed here. If you can easily see that 300 is the amount that we are basically having issued, we can easily say that we are basically in a position that we have completely given out the units that are present in the market that we have been requested at the first transaction. Now moving on to the second transaction. The second transaction says that you are going to have to issue 400 units. So 400 units are to be issued here. Now, how are we going to issue the 400 units? We have to first of all use the remaining units of 100 from 400 and the remaining units of 300 at the price of 12. So we can easily do that. Let's see. So 100 at the price of 15. So 1500. Okay. And then 300 at the price of 12. So this gives me approximately 3600. That is basically my purchases, the second one. So if I add them up, I'm getting approximately 5,100 and plus 4,500. That is my total of 9,600. You see how I went from 7,400 to 9,600, a substantial increase. And if I look at the closing inventory, the closing inventory is how many units? I have only the starting units of 500 only left. So the closing inventory is reduced here. So 500 into 10 gives me 5,000 only. I believe this was easy for you guys for LIFO. Now the table is just representing the same layouts. Now I would want you guys to do the AVCO. I'm pausing the video right now and you're going to attempt the AVCO question and then we're going to solve it together. Okay. LIFO was a tricky one, so I solved it together with you guys, but now AVCO is going to be done by you. Both the methods, perpetual and periodic. Okay, let's continue with the question for AVCO. Now for AVCO, we have to do what? We have to take out our average for each step. Okay. So the average for each step, how are we going to get that? Now, first of all, we have bought 500 units, so 10 is the average cost at the first stage. Now for the second stage, we are having a total purchase of cost of 8,600. So 8,600 is the complete. Now I'm going to use another ink so that it's clear to you guys what are we doing. 8,600 is the total cost, and we have how many units? We have 800 units out of them. So let's see what are the costs that we are having per unit. The average cost will be 8,600 divided by 800 units. That is 10.75. Okay. Next, we have how many units that we have purchased? We have purchased 400 units at the price of 15. That means 6,000. So 8,600 plus 6,000 brings to 14,600. And divide by how many units? 1,200. So 14,600 divided by 1,200 brings me to 12.16, 12.167. Now the issue will be, the complete issue will be on 12.167. So 12, now my issues will be 12.167 into my total. Now the issues are of the same price, so it doesn't matter I do it separately or together. Now I'm issuing how many units in total? I'm issuing approximately 700 units in total. So 700 units in total. That brings me to into 700. That brings me to the cost of 8516.67. Okay. Now 8516.67 is the issues, and the closing inventory will be 500 units into 12.167. That brings me to that brings to our closing inventory at 6083. 6083.33. So you can see that we are having an average moving or between the particular inventories. Average by average, I'm saying that we are having multiple changes. We have seen three strategies through which we are operating, and in three strategies, the AVCO is the one that is coming in between the LIFO and the FIFO. Now, if I go for the periodic measure, that is the easiest method. So for periodic, if I go for it, periodic can be done here directly. So we are having 14,600 units divided by 1,200. That brings it to the same as the one that we have done earlier on. 14,600 divided by 1,200. That is 12.167. And just we are going to multiply 700 and 500 separately for the particular issues. The answer for periodic perpetual is going to be the same in this scenario. The reason being that the movements in inventory are at the end. So the periodic perpetual is going to be the same here, but the workings are separately done so that you are clear upon it. Now you can see that we are on the right pace here, 6085, 8519, and periodic perpetual is going to be the same. Okay. Now I have given the comparison here. You see the comparison that the highest mark is the red flag is which one? The red flag is LIFO. Here we are going to have the highest profit and the highest issue as well. Okay. Here we are having in LIFO the lowest position of the second lowest position of closing inventory, that is 7,200, and the lowest that we are having is basically 605. So the highest profit will be in LIFO, the lowest profit will be in FIFO, and the average, the middle point will be your average cost method. I believe that this was clear to you guys, and how did we operate on these areas. Now bookkeeping entries for material cost. Now, when we have basically done all the workings, we have to record them in the books, right? So if you have to record them in the books, we have to use a store control account. A store control account is basically an account where we are getting the transactions done for the movements of inventory. Now, remember one thing. Remember one thing. You have a storeroom at your home, right? So if you have a storeroom at your home, what are the methods do you record your inventory? The thing that is coming in is debited, and the thing that is going out is credited, right? And we're going to use the same logic here. Okay. In cost accounting, material transactions are recorded as a store control account, tracking purchases, issues, inventory balances. These materials are issued to various departments such as production, overhead, administration. Now remember one thing, and when you are issuing something to a production department, or it is directly related to the product, it is a direct material, direct labor, direct material in general. But if you're issuing any kind of material to any other department, it is an overhead or indirect material. Okay, it will be classified under overheads. So store control account as an example. Opening balances of raw material are 2000, work in progress are 1500, and finished goods are 8000. That means this is available in the store. Now, transactions during the year. The transaction during the year was 40,000 material purchases. If material is purchased, that means it is going to increase the value of the units that are present in the store. Now, direct material issued to production 21,000. That is going to reduce the units that are present in my storeroom. Yes, so that is going to be credited. Then we have indirect material issued to the overhead account to production overheads. Indirect material is overhead. So it is overhead, but in the end, it is reducing the units that are present in the office, in the storeroom. So every issue is going to reduce the storeroom. Every addition, every incoming inflow is going to increase the storeroom. So we can easily say that our debit and credit side, or debit side is the increasing side, credit side is the decreasing side. Is every movement that is coming in having an inflow will increase the left side, and every movement that is taking the goods out of the storeroom is going to move towards the right side. Okay, so the closing balance calculation will be done as follows. Since total materials are available, opening inventory plus purchases must equal to the sum of issues and closing inventory. The missing values are represented as closing inventory here. So they are saying the opening and plus the purchases minus the opposite side is going to give you the closing inventory. So I have made the table here as well for you, but let's just do the calculations as follows. Now, look, what I'm telling you. 2000 plus 40,000. 2000 is what? 2000 is the raw material that we have had. Okay, work in progress and finished goods are not to be issued to any other departments, right? They are basically the department that goods that are already in process. So 2000 plus 4000, 40,000 is the purchases of material. Next, we are going to have the issues of material. So add all issues and subtract 7,000 is the closing inventory that we are having. For the T account purposes, let's make a T account. Now in the T account, I have told you that the left side will be the addition side and right side will be the subtraction side. So first of all, we have opening inventory. We have it for 2000. We have purchases and we have it for 40,000. Next, we have our issues. Whether it be a direct or indirect, doesn't matter. The issues we have indirect selling distribution. I'm writing SND. SND was for 5,000. Okay. Then we had our production, 21,000. We had our indirect production. So I'm writing production overhead by 3,000. And we had our last thing, that was our administration, our admin department, that is having a goods of 6,000. So all transactions done here. Now let's see. Once we have done all transactions, what is the method that we are going to follow? First of all, total both sides. Total both sides. So on the debit side, I am getting, on the left side, I am getting 42,000. Write it down here. On this right side, I am getting approximately 21 plus 9, 30, 35,000. So is the right side having a shortfall here? Yes. So what is the standard method is? Standard method is that write 42,000 total on both sides. The higher total will be written on both sides. And the place where we are having a deficiency is going to have a carried down balance or a closing inventory. So here we are having a deficiency of 7,000 on the right side, on the credit side. So we are going to have a closing inventory. I'm writing it up here because I don't have space. Closing is 7,000 in nature. And then this closing is going to be shown as a opening in the next year, as we did in this current year. As we had opening inventory in the current year, next year the closing inventory for this year will be posted as opening inventory as follows. Like we are going to write opening next year by 7,000. I hope this was clear to you guys. I have done this in the format as well for you so that you are able to interpret, look at it, and how to balance the accounts. You are going to look at it as well. You will normally look at and the financial accounting part, but I have done it for you guys again so that you are clear upon it. Now, closing inventory count levels. Now, controlling inventory levels, basically what is the main objective of the area is that you have to be careful that you have an optimum inventory level. You're not having excessive inventory, or you're not having inventory that is lower than the order that you have. Now there can be two positions. We can have so much inventory kept at our organization that it might go obsolete. It is having so much money tied into it that we are unable to operate efficiently, or there might be a situation where we are having so low inventory that we are not able to fulfill our orders. So both of the positions are going to be very difficult for us, are going to be lethal for us. Okay, so what should we do is we should basically identify the inventory level that is up as of our usage, keep some buffer inventory for us. Buffer inventory is the inventory that is basically kept so that we are in a position that we can have an emergency backup available. If we have an emergency order, we can fulfill it. Okay, so excess inventory and stockouts are discussed. Now, there is a calculation of free inventory. What is free inventory? Free inventory is inventory that is not allocated anywhere else. Basically, it is not required anywhere else. It is not asked for. It is not used anywhere. It is just sitting idly there, idly in the storeroom. So what can we do is the formula for this is stock in store plus on order minus requisition. Okay. Now, what do we mean by that? Now, just understand free inventory. Free inventory says that this inventory is not required anywhere. This is the unwanted guess that we have. Okay. Now, if we have a requisition means a request. If we have a request of inventory of 100 or 200, is it already booked that whenever we receive the inventory, it is going to go at that place where it is requisitioned? Yes, it is. So we are going to look at inventory that is not requisitioned, that has no use right now, but we are ordering it still so that we can keep it as a backup, keep it as an access so that we can use it anywhere else. Why are we calculating this? So that we know what is the inventory that is not utilized yet, so that we can first plan it and then order some extra inventory. So free inventory says stock in store plus on order minus requisition. So stock in store, as you can see here, is 500. That means the already inventory that is with us. We have ordered something. If you have ordered something, is it going to increase the store? And should we take it into account? Yes, we should. Why? Because this is an inventory that is going to help us, in basically operating in the future. Now we are planning for the future. We are planning for the future that in the future, how many goods are there in our storeroom that we can utilize to produce goods. And the ones that are requisitioned are already booked, so we cannot use them now. So the formula will be applied here. So free inventory is going to be here 5 plus 3 8 minus 2 is 600 units. So 600 units are free here. We can plan them and utilize them in the future for any kind of production activities that you want. Now, raw material requirements calculation. Now, raw material requirement calculation, what does it say? It basically says that we have to identify what is the required material. Why are we looking at this? We are looking at this because if we don't know what is the material required, how are we going to buy them and how are we going to plan them? Let's say I am just ordering randomly 5,000 units. There can be a requirement that we have a need of 15,000 units, or we have a requirement of 2,000 units. So we are adding on some material, we are buying some material, we are investing in a place that is not required for. So we have to be careful in that areas that we are not doing these activities. Okay. Now, example, material purchase budget. Now we have to prepare a budget for it. Obviously, if we have to purchase something, we are planning for something that is known as a budget. Now a company expects to sell 5,000 units of product X. Each unit is required of 3,000 material, 3 kg material. Now, what are they saying? They are saying that we have to produce 5,000 units and 3 kg is used per unit. That means 15,000 kg is going to be utilized here. Okay. Now this is not the purchase order that we're going to place. First, we are going to look what is the inventory that we already have and what is the inventory that we have to keep after all the production is done, the buffer inventory. So the opening inventory given to us is 2,000. That means 2,000 is already there. That should be subtracted because this is already there. and they're saying we have a desired closing inventory of 3000. That means at the end we should have 3000 left. That is the closing inventory. That is the amount that we should order. Yes. So at the end, we can say that we have to order 16,000 kgs of material so that we can fulfill all the demands and keep the buffer that is required by us. Is it clear? So the calculation is done here as well. Here, the step-by-step calculation is done, but I've just shortlisted it for you so that you know what we are doing. The main concept here is to plan inventory that we have in a store and we are going to utilize, and what is the amount that we should order. We should not, if we are ordering 15,000, now remember that if you are ordering 15,000 directly, we are under ordering. That means we have to order again. If we are ordering 18,000, that means basically we are not utilizing the inventory that is already with us. That means we have a closing inventory of 5,000 now. That means this is excessive inventory kept that will tie up a lot of capital with us. We are going to have a cash flow problem, and with the problem of cash flow as well, our inventory might go bad. So if my inventory goes bad, that means basically I cannot utilize it. That is a waste of cash as well. So this is the purchase of inventory that we should look upon, and with this we have finished our material costing of MA1. Now there are going to be some other methods as well that are extensive methods that we are going to study in the next sections. But right now for this particular area, the basic calculation of inventory or per unit calculations, this is what you need to know about. So for today, we'll keep it till here. In the next class, we're going to continue. Till then, enjoy learning. Allah.